Hi everyone, I'm back with the second of our two videos, and this is a nice short one, as I promised. It is problem 9-40B on page 532. It's very much like the one that you got assigned as your one of your labs. The other lab is the three ratios, like at the end of the chapter. So this one goes from 2018. There's a small portion in December. They close on the 31st, and then there's some transactions in 2019. And it's for the TLC company. And everything that I just talked about in the notes pretty much happens in this little problem, so it's a great example. So, I'm sitting so I can read it, and then I'll get up to write it. It's so hard to see all the way down for me because I'm blind. On December 6th, we received an $8,000 90-day 9% note in settlement of an overdue accounts receivable from Forest Music. So this is an example of them trading an accounts receivable that's late for a note, giving this customer extra time to pay, but of course they're going to charge him interest. So they're going to have 90 days at 9%. So let's record the note on December 6th. Okay, we have the note, which was granted. No money was given because they already owe the money. And the amount is $8,000 that they couldn't pay, right? So we're giving them more time by creating a note. And then we're going to credit accounts receivable, and they are Forest Music. I'll just put FM for Forest Music for $8,000. I wish I had enough. I'm going to try to write as small as I can, but we'll see. So we established the note for the people, the customer, Forest Music, that couldn't pay us. Okay. So it's the end of the month, right? The 31st. Also, they close on the 31st. So we know this note is in days, and I'm going to put it up here. 8,000 times the percentage was 9%, right? And it's 90 days with 365. So for the whole 90 days, the interest would be, and I have that figured out, 177. Is that right? Yeah, 177. 177. So that's the interest for the whole 90 days. I'm trying to write small. But the period's closing on the 31st. And we have to accrue the interest that's happened in this period. So we have to count the days. So we have to count how many days? 25, right? To the 31st. We have to count 25 days and accrue the interest. So 9% times 25 over 365. And this is the interest that happens. It's going to be very small. In 2018, $49. So 49 of the 177 happens in 2018. This is the total. I know I'm writing small, but okay, the rest of it will happen in 2019. So might as well do that too, so we'll know it. 8,000 times 0.09, and the rest of the days would be 65, right? To make the 90. That's right. If I'm subtracting correctly, 65 over 365. And for 2019, even though we don't need it yet, but we will, it's going to be 128. So 128 interest happens in 2019. 49 happens in December of 2018 in those 25 days that go by. The total being 177. When the music store pays us back, it'll be $8,177 maturity value, principal plus interest. So right now we have to accrue our interest. So we're going to call that interest receivable because we didn't get it yet. We're not getting it for another 65 days. And that is 49. Right? And then we have interest revenue. And I already figured out that in the 25 days, we did $49. Well, so there's our accrued interest for the loan. They want us to close that revenue account, strangely enough, going kind of a throwback from chapter 4. So we're just going to close it to income summary. Why they ask us to do that, I don't know. It's kind of weird, but they do. So they want us to zero out, because it's the end of the period, the interest revenue account. So we'll debit it to close it, and then we'll credit income summary, because that's what we do with revenue, right? So they found a way to even throw in a closing entry here. They found a way. So we're all done with 2018. So now it's 2019. So let's see what happens. Collected the maturity value of Forest Music. So we know how much they're going to pay us because we did the math, right? Altogether, it's going to be $8,177. So this is March the 6th, 65 days later. 3/6/19. Okay, so we have cash for $8,177 debited. Now this is what you're going to find a lot in the homework, the split interest. Okay. So we received the receivable. So we're going to credit interest receivable from 2018. And that was 49. And then we have the interest revenue we made in 2019. And it's a good idea to figure it out even before you need it, and then you have the numbers and you can just put them in. 128. Notice the 128 from 2019 for the 65 days, plus the 49 from the 25 days in 2018 equals 177. The total interest for the whole 90 days. And then of course we're going to credit the note because they paid it. So notes receivable gets credited for $8,000 and they are all set. So that was one trading of a note for an accounts receivable. Accruing the interest for one period and also charging it another portion of it to the new period. Total of it was $177, principal plus interest, $81.77. Credit your receivable from 2018, you got it. Credit the revenue you earned in 2019, and the note is gone. All right? So let's see what happens next. I'm gonna have to erase. June 30th, we loaned $14,000 in cash to Washington Music, receiving a 6-month 12% note. Okay, I got room for that one. Okay, so June 30th, we have a note. And this is the reason of loaning to another business. It's not an individual, but it's a business. Okay, and we're going to credit cash because we're giving them money. I'll put WM for Washington Music. I know this is quite messy, I'm sorry. And then on, okay, before we do that, I think I'll do the math, so I'll know it. Okay, so let's see, that's due in 6 months. So this is the math for the interest. 14,000 is the principal. The rate is 12%, 0.12. The time is 6/12, 6 months out of 12. Interest is going to be in 6 months, $840. So maturity value is going to be $14,000 plus $840, or $14,840. I'll put MV. Okay. I'm going to keep this in the corner. Okay, but I'm going to erase the rest of it so I can finish up with the problem with our last couple of things. So we're going to move to October 2nd, where we give one more note for a different reason. This was given money to another business as a loan at 12% interest for 6 months. Okay, this one's already been paid. We'll get rid of that. Unfortunately, I'm going to have to get rid of this one too, but I'm going to keep the math. If only this didn't shake so much. Okay. All right, so now we're on October 2nd. And here's our third reason. Received a $1,000 60-day 12% note for a sale to ZZ Music. Ignore the cost of goods sold. So this is a special sale. That instead of an accounts receivable, they're granting a note. So in this one little problem, all three reasons. So, notes receivable for ZZ Music. This is October 1st. No, 2nd. Here's our note for ZZ Music. I'll put ZZM for $1,000 for a sale that we made. They say don't do the cost of goods sold. They didn't even tell us how much it was, so we won't do it. So we'll credit our sales revenue for $1,000 because it is for a sale. So they have how long to pay that? 60 days. So let's do the math for that one up in this corner. So 1,000 times ZZ Music, we charge them 12%, and it's going to be for 60 over 365 days. So the interest they're going to owe in 60 days that will accrue is $20. So when they pay us back, they're not going to though, they're going to dishonor the note. The maturity value is $1,020 principal plus interest. I'm going to put MV. And that's the math for that new note. Okay? But they're going to still not give us the money. So, I know because I already did the problem. On December 1st, ZZ Music, 60 days later, dishonors the note. So what do? We have no choice but to put it back into accounts receivable for the maturity value, because remember we earned the $20 interest revenue. It has accrued in those 60 days, so we're going to put the whole thing back into accounts receivable for ZZ. Is that ZZ? Yeah. ZZ Music for $1,020. We're going to credit our interest revenue, even though we didn't get any money, we still earned it. Remember, we credit revenue whenever we earn it. It's recorded when it's earned, whether or not you get paid. That's one of the main principles of accounting. So, already did the math, so we know it's $20. And then we credit the note. It's a similar journal entry to when you get paid. The only big difference is you didn't collect any money. The debit is to accounts receivable, not to cash. If when you get paid, the debit is to cash. So, what they decided to do, I guess maybe the people, the ZZ Music went bankrupt or they left town or something. They decided on that same day they were going to write him off against the allowance account as a bad debt expense. They had their estimate in place at the end of December. We didn't have to do it, but they have one in place, so we're going to charge it to the allowance account, which is odd to do on the same day, but maybe they knew they're not explaining what they know about ZZ Music, and they know they're not going to get the money. So they're charging it to the allowance for bad debts. They're writing against the estimate that they made. They didn't tell us how much they made it for. And we're going to write it for 1020, principal plus interest, and get rid of the accounts receivable. We're assuming we're never getting it, that's why. And if we should get it in the future, we could always reinstate our receivable and then just receive the money. That could still happen. I don't really agree with writing it off on that same day unless you know something catastrophic happened to the business and you're never going to get it. So, one more thing. This one, the $14,000 that we loaned to that Washington Music is going to pay us, and we have done the math already, and we know $840 was the interest that's happened in the 6 months of the loan. So now we're going to get paid back on December 30th. So this we do debit cash for the maturity value, 14 plus 840, 14,840. We credit our interest revenue account. This time we earned it and we got paid, which is nice. Good thing we only got stuck for the little one, for the $20. So 840, and then we credit our note for 14,000. And we got paid. So 2 of them did pay us out of the 3, and 1 of them dishonored it. So this problem, as little as it was, pretty little, right, had everything within those pages I wanted you to focus on. Okay, so that's it for chapter 9, and see you guys next time for our last chapter 11. Bye-bye.